Hello and welcome back to Simple Money, the show where we explore important personal finance questions in short and fun episodes. I'm your lovable host, Matthew Sewick. So today's the first episode of our new series where we look at random financial questions. We're going to start by talking about a mystery, and that's your credit score and what we know about it. Credit bureaus are a vital piece of your personal finance plan. It can help you get your dream home or cause a loan to be declined. Surprisingly, the exact formula that determines your credit bureau is a secret. It's a set of algorithms that we don't know the fine details of. In the vein of 1984, your credit history is constantly being monitored and being rated in the background. Thankfully, we do know some of the most important ways that we can create a strong and healthy credit bureau. By following a few key principles, you can increase your likelihood of achieving your future financial goals. So first of all, the basics. Your credit report is a summary of your entire credit behavior and more. This includes your personal information, your credit products, amounts owing, payment history, and if there is any negative history like collections or bankruptcy. All of this information is then digested through a series of algorithms that generates your credit score. Credit scores range from 300 to 900, 900 being the highest possible score that you receive. If you don't have a credit bureau, your score is simply 0. So businesses, banks, and organizations all will use your credit scores to determine if and how they lend to you. On top of that, many landlords and even employers will request that you have a strong credit rating. In other words, your credit score is really important. The two credit bureaus in Canada are Equifax and TransUnion. The information and internal procedures are slightly different for both, but they're fairly similar with each other. Typically, financial institutions will just use one of the two credit bureaus to gather your information. So how can we really optimize our credit scores? The first big way is through your credit and payment history. This is typically considered to have the largest impact on your credit score, as it's believed that your past credit behavior is indicative of how you will act in the future. So late payments, collections, bankruptcies, and more can all have negative effects on your credit bureau. This is why it's important to make sure that all of your payments are made on time and to contact your credit issuer as soon as possible if you're experiencing any financial difficulties. The idea is you really want to take care of any credit problems before they really blow up into something else. A simple tip to make sure that you don't miss any payments is to make a credit card payment anytime that you're paid. You actually don't have to wait until you receive a statement to make a payment. Another trick that people use is they'll set up automatic payments that cover their minimum amounts. That way they don't miss any of their payments by accident. It's also recommended to verify the accuracy of both of your credit bureaus and immediately report any irregularities. You can verify your credit reports by ordering your information online or by mail. Both TransUnion and Equifax offer a free credit bureau report and premium options for a fee. So the next big factor that affects your credit bureau is your credit utilization. This is essentially the ratio between your total debt balances and limits, excluding your mortgage. The Financial Consumer Agency of Canada reports that you shouldn't use more than 35% of your total credit limits. So for example, you shouldn't use more than $1,750 if your combined lending limits equal $5,000. Using more than 35% of your total credit limits will degrade your credit score. So moving on, another biggie is the length of your credit history. Your credit score is greater when your credit bureau has been active for a long period of time. This also applies to individual credit products because you're deemed to be more responsible and dependable when you have properly managed your credit over an extended period of time. Therefore, it's usually always a good idea to keep your old credit cards active. Number 4, the number of credit checks performed also affects your credit bureau. There are two main types of credit checks called hard checks and soft checks. Hard checks affect your credit score and occur when you apply for a credit card, car loan, rental application, and more. while a soft credit check usually happens when you open up a bank account or when you check your own credit score. It's always a good idea to ask the person that's doing the credit check about how this will affect your credit bureau. Occasional credit checks every 6 months or so is not a problem, but they can quickly degrade your credit score if they're repeatedly done. And finally, types of credit. The types of credit also affect your credit score, and your credit score will be greater if you have a mixture of credit products. For example, if you have a loan, line of credit, and credit card, instead of just multiple credit cards. Thankfully, this principle has the smallest impact on your credit score. That's it for today, but following these 5 key steps can actually lead to a better credit score. Of course, it's always easier said than done, but these guidelines can really help you in the future. Join us next week as we explore how the new mortgage rules in Canada affect you and why everyone is mad. If you have any questions or if you just want to reach out to me, you can contact me by email at info@ffcoach.ca. You could also find me on Twitter at ffcoach. Take care and hope that you're having a great day wherever you are.